In this video, I'll discuss a major investing approach called target date funds. And we're starting right now. Hey guys, Elliot here. So target date funds are a very common approach to investing and something you will see offered to you when you set up your 401k at work. You can also select this approach when you invest outside your 401k, and just about every investment company or broker offers them. In the next few minutes, I'll describe exactly what they are and explain why I think they're a really good approach for most regular investors. As always, if you enjoy these videos, please do subscribe to the channel so I can keep bringing you more content just like this. First off, for those who never heard of them before, let's define what a target date fund is. It's actually a really simple idea. All we're doing here is investing in a way that is tailored to when you anticipate retiring, with the word target in target date fund referring to that date. The reason why we do this is the fact that what you invest in should change as you go through your life. When you're young and have plenty of time, your investments should generally be more aggressive and focus on growth. When you're older and closer to retirement, you will need your money soon and focus shifts to preserving it, and your investments should become correspondingly more conservative. Now, for the sake of simplicity, target date funds focus on three main investing categories or assets that are available to the typical investor. They are stocks, bonds, and cash. Stocks are more aggressive and are for growth of capital, while bonds, along with cash, are more conservative and are for preservation of capital. All we're then doing is assigning more growth assets when you're younger and gradually reducing them as you get older, substituting assets that will preserve your money in their place. And that's really target date funds in a nutshell. What we're doing here is called asset allocation, and it's a fundamental tenet of modern portfolio theory, or MPT for short. MPT was introduced in a 1952 essay by Nobel Prize winning economist Harry Markowitz, and while the theory has its critics, it has stood the test of time. Markowitz proposed that people in general prefer an outcome that minimizes losses over greater returns, even if the end result is the same. He then went on to state that an investor can reduce risk by holding combinations of diversified securities, debt, and other instruments with their ratios carefully tailored to optimize both the risk and the reward. This does seem rather common sense today, but was considered quite revolutionary back in the 1950s. Markowitz then proposed 5 different types of portfolios that I'll show you right here. They range from a very conservative, also called defensive portfolio, all the way up to a very aggressive, also called speculative portfolio. In between were the more middle-of-the-road portfolios that were called conservative, moderate, or hybrid, and aggressive. All of these portfolios held a mix of stocks, bonds, and cash, with the more aggressive ones leaning into the stocks far more, and the conservative ones relying heavily on bonds. Now, originally, these portfolios weren't tied to age and retirement, only to the risk profile of the investor. You could, after all, be the type who's very conservative at age 20, or be that crazy grandpa speculating on stocks into his 70s. However, that wasn't what most rational investors did, and it was very logical and reasonable to advise investors to behave more aggressively in their early years to maximize growth and profit, and gradually taper down and preserve the money as their working years wound down. And thus, target date funds were born. So what do target date funds look like today? Well, here's a typical example that you would run into, as offered by T. Rowe Price, a major investment management firm. Now, this is just an example I selected. I'm in no way endorsing T. Rowe Price, but no matter who you go with, target date funds will all look roughly the same. As you can see, there are 7 categories, with each retirement date being a few more years out into the future. You simply estimate when you think you may retire and click the link to see what investment strategy is offered for that date. For purposes of our example, let's say you are currently 40 years old and think you may want to retire at 65. That is exactly 25 years from now, when it will be the year 2049. We'll round that up slightly to the next available target date of 2050 and see what the recommended mix is. To no one's surprise, 25 years until retirement is considered a very long time horizon, and the recommended mix is quite aggressive at 66 and 29% domestic and foreign stocks respectively, and just 2% to cash and less than 1% to domestic and foreign bonds. Compare that now with someone about to retire next year. Here's what the 2025 target date fund looks like. All stocks, foreign and domestic, now make up only about 57% of the portfolio, while bonds shoot up to 36%, and cash makes up nearly 6%. It's clearly a far more conservative approach. I won't go through the rest of the target date funds, as I think you get the idea. Now, the exact percentages will certainly be different between the various investment management firms, as each may have their own philosophy and approach, but no matter who you go with, the central theme will be the same. You start out with an aggressive portfolio and gradually move toward a more conservative one. This changeover, called rebalancing, happens every year and is done automatically. Now, I mentioned earlier, this type of investing approach is a great idea for a lot of regular investors, and the reason may already be quite obvious. It's very simple and it's very hands-off, which is perfect for those who have little interest in the nuts and bolts of investing, but at the same time know how important it is, and that they should do it. For these passive investors, which is the vast majority of Americans, it's simply a matter of picking the proper target date and automating the contributions. The investment management company will then automatically rebalance the portfolio through the years until the target date is reached. For you, the investor, this will go a long way in maximizing gains while minimizing risk. Now, as I wrap up this video, it should be mentioned that this approach is not for everyone. If you're an active investor, which represents about 10% of all US investors, you may prefer to pick your own asset classes and may feel your knowledge and research will allow you to take bigger risks for larger gains. But for millions of investors, this set and forget approach that target date funds offer is far more appealing and easier. As a financial advisor, I support both methods as long as you invest in the first place, as sitting out and not investing remains the biggest risk of all. If you enjoyed this video and found it useful, please do subscribe to this channel and turn on notifications. Thanks for watching, and I'll see you all soon.